This is the highest yield they've ever paid, ever. You know how crazy that is for like the second largest company in Canada? We are returning 100% of our free cash flow to shareholders. Woo, baby! We're gonna talk about Canada's highest dividend yielding companies because they are also some of the largest market cap companies and they are getting decimated right now. We're gonna talk about things like telecoms, like Bell with an 8% dividend that is still increasing that dividend. We'll talk about Toronto Dominion Bank, money laundering, baby, tanking the stock. Is it a buy? Well, I got a video we're gonna watch that's gonna decide that for us. And finally, energy, what Canada's famous for. We got Canadian Natural Resources posted earnings. Next up is Enbridge, and if that is a conversation you'd appreciate, damn it, on your path to financial independence, so perhaps one day retire early, go down there, hit that like button, and subscribe to join me on my journey here, because I primarily own VDY, the Vanguard Canadian High Dividend Yield ETF that pays monthly, and all these companies to some extent are a proponent of that because, again, Canada's largest companies yield insane dividends and you can take advantage of it through one ETF. So when the top holdings are extremely volatile heading into an earnings season, I want to pay attention. I have large exposure to some of these companies. Now, one of my favorite companies that my fiance has direct exposure to is a company called Telus. Debating on picking up the dips here soon. The thing's down 34% from its all-time high. And the reason it's been one of my favorite Canadian stocks is because it has consistently grown and has a very diverse business in security, telehealth, a variety of different businesses outside of just telecom and internet, right? And they're going to be posting May 9th, and they tend to beat analyst expectations, but honestly, when your analyst expectations are set so low, they're kind of easy to beat. Let's talk about Bell, though, because it did post earnings, and in similar fashion, it is also down a whopping 37%. Both these companies are trading between a $30-40 billion market cap, but with an 8.67% yield that they are still planning to increase this year. You know how insane that is? You don't need this stock to go up or down. If you are in retirement, if you are looking for cash flow, that is a full rate of return, presuming it will be stable. So let's ask us, how stable is that dividend? Well, we can see over time, it has gone up pretty nicely in the last 5 years from 79 cents to $1. And if you take a look at that dividend scorecard, their 5-year growth rate has been 11.2%, which is insane. Or sorry, it's a 4-year growth rate. And analysts right now have been beating it up. They say the stock's worth between $54, give or take. There's been a lot of price reductions on the stock, which makes sense. Higher interest rates, infrastructure-oriented companies, I get it, right? If you take a look at analysts, they have it spot on between an average of around $50. High end is 55, low end is 42. We're at 45. Honestly, I think, again, there's no rush into the interest rate cut cycle, but if you have a long-term mindset with the immigration that goes on here, it's the reason that I feel like telecom are one of the few industries that benefit largely from this. And we see it in the earnings, right? Let's talk about this because from an operating revenue standpoint, there hasn't been a whole lot of growth. I get it. It's a very matured company. Net earnings are obviously down because of cost basis and interest expenses we'll talk about in a moment here. But what I really want to pay attention to is some of the growth, right? So if we take a look here, what's neat is with Bell specifically, they have a media division. They just did a massive layoff period of laying like 10,000 people off or whatever. And that's going to benefit, the coming quarters on their earnings per share, which is, I think, going to be a bonus as much as the government hated it. Because, basically the government approved them to buy all these little local media companies. And then when they said these things are unprofitable, let's get rid of them, the government was pissed because they helped out. They gave some tax breaks, blah, blah. That's business. We've seen it with GM. It happens all the time. The government shouldn't intervene or get involved with big companies and buying up other things. Anyways, but taking a look here, we can see that one of the things they do focus on, however, is Crave. Crave subscribers are up 7% year over year, and 31% growth in sports and DTSC subscribers. So they're seeing growth in their media division, and advertising is up. When you take a look at wired lines, which is surprisingly is up with retail internet net adds of 13.9% year over year, mobility internet sales growth 39%. There's a lot of good growth vectors here. It's just not really hitting the bottom line as much as they'd like to see it, which again comes into the expenditures. And what I told you is don't trust the dividend payout, because if you look at the current dividend payout ratio, it's like 129%, but it doesn't take into account that they depreciated, like just in this first quarter, $946 million. And that depreciation, guys, is just taken out of the cash flow as, hey, I bought this asset a while ago and it's going down in value, so let's write it off against cash flow. It's really easy. Same with the amortization kind of cost here. But when you look at the interest expense, man, it's at $416 million, which is just insane. They spent for the total year of 2023 $1.47 billion on interest expense. And that is a crushing amount of return that could have hit the bottom line, or at least, a good percentage of it if we weren't doubled up in the interest rate, right? So I'm very excited to see where these companies go in the future. I feel like if you're a long-term investor, cash flow oriented, this is some of the best buying opportunities of a lifetime. And speaking of that, the banks, I think, also sit in the same category because these are the largest companies in Canada. TD trades for $135 billion and has become one of the largest banks in the US as well, and is currently yielding 5.34%. And what I want to point out to you here is TD, if you look at the dividend yield on macro trends now, this might pull up the US ticker, but I just want to show you that if you go through its history, this is the highest yield they've ever paid, ever. You know how crazy that is for like the second largest company in Canada? And you know the money laundering story, right? I mean, basically Chinese fentanyl drug dealers somehow bribing people in TD, you know, laundering hundreds of millions of dollars, which I don't know how you catch laundering money anyways, unless someone tips you off, because God knows if I'm running a bar or a salon and I'm running cash, we all watch Breaking Bad. We get it, right? But the fact is there's a really good question in here. I kind of skipped to. I want you to just take a listen to this.
No reason. So there, of course, is a serious reason that's taken TD down to these levels, but you've rarely been able to buy it when it's this cheap or sports a dividend yield this attractive. Yeah. What do you say to investors who are trying to make that kind of calculus? Because in some ways, and you mentioned this in your notes, that this is not without historical precedent. Other banks have found themselves in similar situations.
Yeah, the valuation argument was being made for TD over the past month or two, and TD's stock price, its price to earnings multiple, had gotten to unprecedented levels, discounts versus its normal premium. And my response to that at the time is, well, valuation alone isn't a reason to buy a stock.
True.
You have to think, what's the cause for the valuation to be that low? And in this case, it's such a murky situation with a lot of uncertainty attached to it and with a lot of long-term implications as well. I mean, that to me seemed a little bit too simplistic to focus on the valuation alone. And as it happens, it would have been, it wasn't the right move to focus on valuation. And you know, just because it's even cheaper now, what would I say to somebody? Well, wait and see. Don't be early to the party, because these things could have a few more negative news announcements. Mind you, I think we're probably closer to a bottom here, valuation-wise, but a stock can stay cheap for a long time, and I think that's the most likely scenario here.
Does it?
Let's just finish it up, but I hate what he says here. I think it's just like the worst advice, that just wait and see. Oh, but maybe it's bottoming. Maybe it's bottoming. I don't know, but wait and see.
Does it increase the impetus for a leadership change?
No, let's not start the political front here. But when it comes to buying stocks like this, you have to recognize that there's going to be tumultuous periods with every company. You're seeing it with Tesla. We're seeing it with Apple. You're seeing it with Starbucks. These are AAA rated brand companies, and anytime they've gone into trouble, it's always presented a buying opportunity. But you have to have kind of a headstrong reality that 3-5 years from now, we're not going to see the troubles we have now, and in 10 years we probably won't even be discussing it. I think Wells Fargo is like one of the prime examples, though different issues, still fines involved in the hundreds of millions, billions of dollar range. But Wells Fargo, I mean, back here, everyone thought that the game was over for Wells Fargo, right? And they came flying out of it after paying those fines to fully recover and offer 175% gain. So you have to imagine that cost averaging into your favorite companies, this is the most healthy, smartest thing you can do, instead of listening to a moron go on about, oh, maybe not bottom, don't catch the falling life. And I agree with some of those statements, but you kind of got to start cost averaging somewhere, and it's better to cost average on the way down, in my opinion, than on the way up. However, taking a look at the dividend here with TD, absolutely insane growth. 47 cents a decade ago. Today you're getting $1.02. If we do the dividend scorecard, I don't think it's as good as Bell, but I mean, 7.75% over 13 years is insane. Very healthy, right? So TD, I would put on the list. Obviously with VDY, it makes up a huge percentage of that. So I just like buying VDY. My fiance does own it individually as well, just part of his family unit here. We do own some TD. Now let's talk about Enbridge here, because this is also a very big dividend player that has actually been rallying back nicely with the oil prices. This is a great buy back last year, and I don't know if it's starting to get a little bit valued here because oil is retracing a little bit. But taking a look in comparable, because this thing is going to be posting on May 10th, which can be another great thing you can subscribe and follow for, is Canadian Natural Resources, right? Like they posted already in tandem, and I can't really understand this company that well. I'm going to listen to their earnings call and kind of go through their presentation, try and wrap my head around it, because I never understood why the stock has rallied so aggressively, other than they've taken this notion of, we are literally going to be giving all of our money to shareholders. I mean, you know, I was diving into this, and I wanted to take a quick look, because the earnings weren't great. I mean, you take a look at net earnings, they're under $1 billion now, which seems odd because the last few quarters were amazing. Earnings per share not great. Cash flow activities and expenditures have kind of been going up. And when we kind of just compare it to, like, if you read into this, basically they're also going to be splitting shares. So Canadian Natural Resources is going to announce kind of a split share. I'm trying to find the earnings. I think the earnings were up here. If we read into this, they say Canadian Natural is a world-class company. Let me read into this. We'll zoom in a little bit. During the 35 years of operation, we've delivered significant value, including recently reaching a position where, commencing in 2024, we are returning 100% of our free cash flow to shareholders. And again, in an oil industry, if you are a dividend-oriented investor, I don't think there's anything wrong with that, but they have huge reserves, right? So I feel like they just have this massive asset and they've given up on growth. They're like, we don't need to invest money into anything into the future now. We're just going to give it all to you guys. So if you buy Canadian Natural Resources, you're buying basically the full rights to the income of this resource, which is fascinating to say the least, right? But you got to take into consideration, what does this mean, especially in a time where this, the earnings are going down, yet the stock is rallying so aggressively. The company's going to split in half to make it seem cheaper. That seems like a falsehood of making the stock more affordable. But statistically, every time they do dividend splits, the stocks do perform better from a psychological effect. But yeah, hasn't had a lot of growth recently. I'm interested in what's driving the stock and what you guys think about it. But I'll pass the question off to you. I'd love to know what you are doing in the midst of Canadian earnings season, because of course your boy will be buying. But let me know what you think in that comment section below.